Hey everyone, welcome back to Corporate Decoder, the place where we decode the complex world of business and finance, and today we're diving into the nitty-gritty of Crane Harbour Acquisition Corporation's 2025 annual report, Form 10K. Get ready for some spectacular insights, or perhaps a different kind of financial story. Before we jump into the numbers, if you are all about cutting through the corporate jargon and getting real about financial reports, make sure you are subscribed. And hey, we've got a growing community on Discord where we break down these filings together. The link is in the description below, so come join the conversation. So Crane Harbour Acquisition Corp. This is a special purpose acquisition company, often called a SPAC. Think of it as a company that goes public with the sole mission of finding another company to merge with. They raise a bunch of money from the public, park it in a safe place, and then have a limited time to find a suitable target. If they don't find one, they usually have to give the money back to the investors. This filing covers their year up until December of 2025. They filed their IPO, which is their initial public offering, in April of 2025. That means this report is essentially documenting their very first year as a public company, a year dominated by setting up, raising funds, and actively searching for that all-important merger target. Now let's talk about what makes these companies tick. A SPAC like Crane Harbour exists to bring another company to the public markets. They don't have their own products or services. Their entire existence is about that future merger. So what is crucial here is to see how much money they raised, how much they've spent, and what their plan is for finding that merger. Crane Harbour sold units, and each unit had a Class A ordinary share and a right attached to it. These shares are what the public bought. The company also has Class B ordinary shares, typically held by the founders or sponsors, which often come with different voting rights and conversion terms. Spoiler alert, nope. Crane Harbour is wisely checking no for being a well-known seasoned issuer. That just means they're not a giant established player in the market yet. They're still in their early days. As of early 2026, they had about 22.6 million Class A shares and over 7.3 million Class B shares outstanding. This gives you an idea of the ownership structure. The Class B shares, often held by insiders, usually convert into Class A shares upon a business combination, and their ownership is a key factor for the sponsor's stake. This glossary is a lifesaver, defining terms like founder shares, initial public offering, and the all-important completion window. That completion window is critical. It is the deadline by which the SPAC must complete a business combination or start liquidating. Crane Harbour's deadline is the 28th of April 2027, meaning they have about 16 months from the end of 2025 to get a deal done. Like most filings, this section warns us that any statements about the future are just that, statements about the future. They're not guarantees. Company management believes certain things will happen, but reality can be very different. This is standard stuff, a reminder to be cautious about what you read regarding future plans. This is where we get to the juicy stuff, the potential pitfalls. And for a SPAC, the risks are pretty significant. They have no operating history, meaning there is no business to analyze before they merge. Their shareholders often only get one shot to say yes or no to a deal, and that is through their redemption rights. This is the core risk. They are a shell with cash. Looking for a business, you are investing in their ability to find and execute a deal, not in an existing operation. This is a big one for investors. If you don't like the deal the SPAC finds, your main recourse is often to get your initial investment back, minus some potential fees. You don't get to negotiate your exit, you just redeem. Alright, let's get into the meat of their business operations, or rather, their business intentions. Crane Harbour is a blank check company formed to merge with another business. They haven't made any money yet, and they won't until they complete that merger. Their stated focus: the technology, real assets, and energy sectors, looking for companies with disruptive solutions and strong growth potential. They want to accelerate growth by providing expertise and capital. This is a major development mentioned in their business section. They've actually entered into an agreement to merge with Xanadu Quantum Technologies Inc. This is what they've been working towards. The deal involves a continuation into Ontario, Canada, with the target and Crane Harbour becoming subsidiaries of a new parent company, Pubco, whose securities would then be listed on NASDAQ. This is the big story for them right now. Their strategy is crystal clear: find a target company, merge, and then help that company grow using their management team's experience in strategy, finance, and capital markets. They highlight their team's SPAC track record, referencing successful combinations like Falcon Minerals and Osprey Energy. Their chairman, Mr. Cohen, has a very strong background in energy and finance, having founded or led several major companies. Here is a key point. NASDAQ rules require the business combination's fair market value to be at least 80% of the assets in their trust account. For a SPAC, this is a critical hurdle. They can extend their completion window, but usually not beyond 36 months. If they don't find a deal, the sponsor's investment in founder shares and private units becomes worthless. This is a critical point for investor protection. While public shareholders might vote against a deal, the insiders who hold founder and sponsor shares have agreed to vote for it. This significantly increases the likelihood of a deal getting approved, even if the majority of public shareholders disagree. So, in essence, your vote might not matter as much as you think if the insiders' votes push it through. This is the lifeline for public shareholders. If you don't like the deal, you can redeem your shares for cash. The amount you get back is tied to the money in the trust account. This redemption feature is a key part of the SPAC structure, giving investors an exit if the deal isn't to their liking. This reinforces the urgency. If they miss their deadline, the shares get redeemed, and the rights expire worthless. So that deadline is a constant pressure point forcing action. This is where the detailed, scary scenarios are laid out. We touched on some key risks earlier, but this section elaborates. Remember that insider voting agreement. This risk factor reiterates that you might not even get a direct vote, or your vote might be overridden. This highlights the power dynamics inherent in SPACs. This is a classic SPAC concern. The sponsor often gets shares for a tiny fraction of what public investors pay. When those founder shares convert, it can dilute the value for public shareholders. The report even includes a table showing how the sponsor's initial investment of a few $1,000s for founder shares can bloom into millions. Even if the public shareholders see their investment value decrease, it clearly shows the sponsor's potential profit is largely insulated from the share price after the merger, which could create misaligned incentives. This is the fundamental risk. They are a vehicle, not a business. Everything hinges on a successful future merger. Here we get a snapshot of their shares and how they're traded. Their units started trading in April of 2025. It is important to note that units often separate into shares and rights, and those start trading separately later, which affects liquidity and investor choices. This is management's narrative of their financial situation and performance. Again, they confirm they're a blank check company, incorporated in the Cayman Islands with no revenue yet. Their main goal is a business combination. They expect to continue incurring costs for operations and finding a deal. This is interesting. They report a net income of over $3.5 million. But wait, there are no operations. This income comes from interest earned on the money they've parked in their trust account. It is not operating profit, it is investment income on the IPO proceeds. Management costs eat into that, leaving that net income figure. This section reiterates their agreement to merge with Xanadu Quantum Technologies Inc. This is the big event they're working towards. The details about continuing into Ontario and listing a new pubco on NASDAQ are critical parts of this proposed merger. Here it is, the trust account balance over $226 million. That is the war chest for the merger. They also had about $267,000 in cash outside the trust account for operational costs. The report notes substantial doubt about their ability to continue as a going concern without a successful business combination. This is standard for SPACs, as their survival depends entirely on that merger. This is the auditor's stamp of approval. They're saying the financial statements present fairly, but they also explicitly mention substantial doubt about the company's ability to continue as a going concern. This is due to their lack of capital resources and reliance on a future business combination. Let's look at the numbers. The asset side shows a significant chunk in that trust account, over $226 million. That is the money raised from the IPO. The cash outside the trust is about $267,000. On the liabilities side, you see accrued expenses and a significant deferred underwriting fee of $8.8 million, which is only paid if a deal closes. Then, the most striking part is the Class A ordinary shares subject to possible redemption line item at over $226 million. This basically represents all the shares sold to the public that could be redeemed for cash. It's classified separately because redemption is outside the company's full control. Here is that net income again. It is entirely from interest earned on the trust account, about $6 million offset by formation and administrative costs. Remember, this isn't profit from selling anything. It is just the return on their parked money. This shows they spent nearly $2 million on operations. Primarily, this is from the costs of running the company and searching for a target. The cash came from financing activities, mainly the IPO proceeds. These notes are where the details live. They explain the Class A and Class B shares, the rights, the trust account, and that crucial completion window. It also highlights the Xanadu deal as their proposed business combination. This line item is vital. it shows the shares sold to the public and at what redemption value. The redemption value per S-share is now over $10.28, slightly more than the initial $10 because of the interest earned in the trust account. This is the money public shareholders are entitled to if they redeem. This confirms the Class B shares held by the sponsor and founders, representing their initial stake. The earnings per S-share calculation reflects that unusual net income. Because most shares are redeemable, the basic and diluted earnings per S-share are calculated differently, essentially allocating the trust account interest income to the class of shares. This section lists all the contracts and legal documents that support the filing. It includes agreements signed for the IPO, the business combination, and corporate governance. It is the paperwork that backs up everything we've discussed. Here we meet the team. You've got a lot of experienced names here, many with backgrounds in finance, energy, and crucially SPACs. Jonathan Z. Cohen, the chairman, has a deep history in SPACs and has been involved in several successful mergers. His experience is key to finding and executing that deal. William I. Fredin, the CEO, also has significant experience in finance, M&A, and SPACs, including advising other SPACs. He is clearly the driving force behind finding and closing a transaction. The company lists its independent directors Eldrum Blackwell, a Coyote Ogenro, and Trey Karlovich. Their independence is important for corporate governance and overseeing management, though remember the insider voting agreements we saw earlier. The compensation committee, made up of independent directors Karlovich and Litvin, handles executive pay, but for now actual cash compensation is minimal, with directors receiving indirect interests in the sponsor. Here is a look at who owns how much. William I. Fredin, the CEO, and Crane Harbour sponsor LLC together hold about 25.9% of the voting power, largely through those Class B founder shares. This shows the sponsor's significant control and stake. Several institutional investors are also listed as owning more than 5% of the company. Barclays PLC, AQR Capital Management, LLC, and others hold notable stakes, indicating significant institutional interest. This section details any deals between the company and its insiders. It reiterates how the sponsor got their founder shares for a very nominal price. It covers the lockup periods for these shares and how they convert into Class A shares. This covers the private placement units bought by insiders and institutions alongside the IPO. These are similar to public units but often have different transfer restrictions. This is important. Crane Harbour received a $700,000 advance from the sponsor in November of 2025 for working capital. This shows they needed external funds to keep operations running even with the IPO money. This is a crucial section for any SPAC. It details all the ways insider interests might not align perfectly with public shareholders. Their fiduciary duties are highlighted, but also the waivers they've agreed to, like voting for any deal and waiving redemption rights on their founder shares. The report makes it clear. The sponsor and management have significant personal financial interests tied to closing any deal which could influence their decision making. Their auditor, Withum Smith Brown, charged about $150,000 for their services, mostly for the audit and IPO related filings. Okay, diving into the official financial statements. As expected, the balance sheet shows the vast majority of assets are in that trust account, over $226 million. Their actual cash on hand is small, and they have a working capital deficit. The liabilities include that significant deferred underwriting fee, payable only upon closing a deal, and crucially, the Class A ordinary shares are listed as subject to possible redemption, highlighting the outflow risk. And here is that net income from interest again, around $3.5 million on top of the $6 million in interest earned. Their operating loss is just over $2.5 million, which is effectively their operating expenses. The cash flow statement shows they used about $1.9 million for operating activities. Investing activities show a huge outflow of $220 million, which is the money put into the trust account. Financing activities reflect the IPO proceeds, bringing in over $222 million. This note confirms their status as a SPAC and reaffirms that existence relies solely on that business combination. It also reiterates the Xanadu deal and the critical completion deadline. This is the auditor's explicit statement of doubt about the company's future without a successful merger. It is a stark reminder of the inherent risk in SPACs. So, what is Crane Harbour Acquisition Corp? Story: they're a SPAC that has moved beyond the initial fundraising and has actually found a potential merger target, Xanadu Quantum Technologies Inc. This is a huge step from just being a pool of cash. The deal involves a re-domicile to Canada and listing a new parent company on NASDAQ. The financials, as expected for a SPAC, are dominated by the IPO proceeds held in trust. The reported net income is just investment income, not operating profit. The real financial story here is their reliance on closing the Xanadu deal by their April 2027 deadline. Failure means redemption for shareholders and likely a worthless outcome for the sponsor's initial investment. The risks are substantial. The sponsor has a significant voting advantage, potentially pushing through a deal even if public shareholders disagree. The dilution from founder shares is also a concern for public investors. However, the biggest positive development is that they have a concrete target. The success of Crane Harbour now rests almost entirely on the successful completion and subsequent performance of this Xanadu merger. Ultimately, Crane Harbour Acquisition Corp is in the critical phase of its existence. They've identified a target, and now all eyes are on execution. The success or failure of this merger will define their legacy. Now, looking at these results more broadly, Crane Harbour's direction is now tied to Xanadu's quantum technology. The ability to close this deal, navigate regulatory hurdles, and integrate operations will be paramount. The risks related to SPACs, like insider advantages and deadlines, are ever present, but the concrete deal with Xanadu offers a path forward. Alright, that is our breakdown of Crane Harbour Acquisition Corp. Its latest filing, what is your take on these numbers and what they signal for the company's future? Especially with this Xanadu deal on the horizon, drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into corporate filings. Don't forget to check out the Discord in the description to join the conversation. Thanks for watching, see you next time.